stock fundamentals with regard to IT. Sandip Agarwal, fund manager at Sowilo Investment Managers, joining us this morning. Sandip, always a pleasure having you. Now, I know you were bearish with regard to how valuations look, but talk to us about how you're reading through the commentary of TCS. First off, does the 3% fall with regard to employee headcount worry you? Is that something of a bit of a worry, or do you believe that this is just temporary and the bounce back will be equally good? Because they're speaking about demand recovery likely in FY27. So give us that sense first.
Yeah, hi, good morning, and thanks for having me on the show. So, I am not at all surprised with the fall in employee count because, in my opinion, that there must be rationalization of employee across IT services companies. Now, there are two ways to do it. One is obviously the natural attrition not getting refilled, which most of the companies would have done their best to achieve. And then after that, if there are some employees who still you want to, are not fitting in your strategy, then obviously you will have to do that. So I am not at all negative. In fact, because they have done this, their margins have been intact and they can do slightly better margin because see, you have to understand AI itself means that your efforts will go down by 30-40%. So you can't keep adding people when your efforts are going down. So I think that is actually a positive and not a negative for any company in the sector. Everyone must rationalize their workforce to maintain their profitability and growth. AI by nature needs less number of efforts. That is one. Number two, on the commentary, I would say that, see FY26, that is what we were saying earlier. Also FY26, you will not see any big numbers. Even in FY27, I think from IT services, expecting large cap to be more than 6-7% growth is too much. I don't think that will happen. Now, additional revenue coming in from new streams, that is something which no one has an insight, no one has the insider information on that. But if you announce something and revenues start coming from that in future, then that will be an additional revenue, which will also imply that there will be additional investment. So you have to look into the outcome of ROE and margins also from that perspective. But as of now, I think, I don't have any change in opinion. I think that the large cap IT companies won't see more than, mid-single to high single digit growth. And for that growth, the multiples are quite decent, or maybe I would say relatively higher.
Interesting. Sandip, what is your, analysis on this $7 billion investment that they've announced that they're going to be making in data centers, and that they are now going to be looking at acquisitions as well to capture the AI opportunity? Do you think services players like TCS, or for that matter Infosys as well, can really transition into AI-driven companies in the due course of time?
No, 100%. See, this is a very good thing. I see this is a very positive thing to happen because remember that, these companies have much higher advantage than anyone else who is coming into the data center business. So they obviously have the technical know-how. They have a very strong balance sheet. They don't have to worry about money. And, they already have a services business, which is a cash cow. So it is a very good extension. I would say this is a good step. Obviously, numbers will take time to come because, data centers take 18 to 24 months to come when they start contributing to revenue and all that. And generally, because it is a part of technology ecosystem, there could be some disruption, there could be margin disruption also within that business. So I would not say that, they will be able to make the margin which they're in services, doing in services business today. Because number two things, in 2 years, a lot of other companies will also come with similar business models and with bigger capital in hand. So, margins may be a little lower, but at least it is much better than doing the buybacks which they were doing. So I think that rather than doing buyback, extending into related areas is a much better thing. And obviously when you start that, then, you can do small acquisitions which can keep on adding on your capabilities. So, this is the way all the big techs have developed. If you see the kind of acquisitions they have done over the last 15-20 years, a lot of acquisitions they have done. I don't think there is a material change in the numbers in next 2 years because of this, but at least the capital has been utilized in a positive way.
Okay. Sandip, what do you make, or what's your sense with regard to what happens to return ratios as a result of this very, very large investment? Because, okay, it may just be maybe over the next 5 to 7 years, it may be 6-7% of the market cap of a TCS, but it gives you a direction into how TCS is thinking with regard to earnings growth going forward. And that may mean that they may be willing to make larger investments as well. Do you believe that this basically could be a headwind to the return ratios that some of these Indian IT companies and TCS in particular clock?
So I think, what the company has done has taken a middle path, to be honest. So there was one path where you go aggressive in R&D and start building AI capabilities, which would have burned 20, 30, $40 billion. Then you have to compete with the likes of the big tech, where, they are burning $100 billion a year in R&D. And also, I don't think that was a possible path. And the other path was distributing that money for buyback or dividend. And in the middle, there was a path where you are not going to burn money like that. And that was this business which they have announced, where you are certain of making returns. Returns could be less or more, but at least it will be much higher than what they would be doing by keeping the money in banks and getting 6-7% return, which is also taxable. So I think from that, the middle path, I think this is a better path, because that R&D path, I don't agree that Indian IT companies do that so aggressively, because neither we have that kind of balance sheet. And secondly, at some point of time, it will cannibalize in and compete with their high-tech vertical, which is not an advisable thing to do in my view. So this is a better path in my view, and in this path, the chances of write-offs is very low.
Read through with regard to other IT, is there a positive read through in your mind?
See, the natural read through for everyone will start thinking, whoever has a huge cash balance, whether it is the Infosys, HCL or Wipro, they will all take this path. That is the natural read through, and we have huge demand which will come for data center in next 5, 7, 10 years. And these companies, honestly, I believe, are much better placed than the other data center local players who are coming. I think these companies have a significant advantage on the technology side. Their cost of capital, actually, you should see it as 6% only, because they are keeping that money and they are getting only 6% other income. So I think that they have the best of both worlds. So I think this is a good step, and this is the right thing to do, and this step has much lower risk than any other step they would have taken. So I think all will slowly get into this.
Right. So Sandip, very quickly, you're not revising your price targets on TCS, are you?
See, I run a PMS, so we don't have any targets or anything, and so it is very tough to say that. But we believe that large cap IT sector on their own IT services, there will not be more than 5-7% growth. But this kind of action which they have taken to utilize cash is really good in my opinion.
Okay, so let's see how those stocks pan out today. Sandip, good to have you on the show. We'll take a very quick break on that note. Come right back.